For the true few that made it this far, welcome back. This is the last segment of the three-part series that we did on Tamarack. This part, we discuss about the DeltaStream acquisition. We talk about Brian's level of satisfaction, the integration, along with the concern that some people have at year end. They might not have seen the type of reserves that they were hoping to see with an acquisition of this size. So we discuss that, and along with acquisitions and divestitures and where Brian's focus going to be moving forward between the two. And we wrap up with a call to action. Why Tamarack and why now? So we discuss some of the catalysts along with it. And then we wrap it up. So it's going to be about 50 minutes to an hour. And hopefully that would give you a better understanding of the company. Enjoy. And we'll see you guys when we cover a different company. All the best. So at this point in time, I thought it would be great to transition to the DeltaStream acquisition, which, in
Yeah.
your words, once in a generation buy. Everyone's got an opinion, but you only know through the passage of time. But it looks
Mhm.
like this was a unique acquisition, and I've heard just through other competitors that wish that they'd ended up with it as well. Can you walk us through this purchase and how it arose? I knew at one point in time it looked like there wasn't going to be an acquisition, but you're not in control of these things. You just have to react based on when they present themselves to
Yeah.
you.
Yeah. So DeltaStream was pretty much entirely an ARC-owned company, private company, very successful, got themselves into the thick part of the play in that Martin Hills 25 meters. So basically you had Headwater and Spur and DeltaStream there. Good. Some operators had initiated water floods. In our opinion, it's probably not going fast enough. You're not injecting enough water in some of those. But you got 60 million barrels a section to work with there. It's just a tremendous asset. Wells that I understand some of those wells originally are in like the 15 times payback. Like it's just phenomenal. So you're gonna it is the creme de la creme of the Clearwater. And there was lots of drilling left to do there, lots of exploration left to do, synergies with Nipisi and our own infrastructure build out that we could take advantage, and water flood in the Nipisi area as well. So it was a great asset, and I will tell you that rarely have I worked on that asset stands out in that the net asset value that we calculated internally was way more than anyone could pay for it. Including ourselves. There was a lot of, when you do acquisitions, you tell the engineers to go put their nabs together and figure out what you can do with the asset and come back with what you think it's worth. And then you talk to the finance guys and what you're willing to pay that you can afford to pay for it. And that was the challenge. All the value was there. There was a ton of value, but the real creativity had to come with the financing. How could you bring that in a market that was, equity constrained? You weren't going to go raise a bunch of money. You're going to have to do it somehow with some debt. And the good thing is that all the assets we bought before it, the Anegada, Crestwind, and all those assets before built up our base so we could take debt to use the debt to pay for a significant portion. But I will tell you that the net asset value it was so high on this. There's so much opportunity there. It's phenomenal. If you recall, Sohaib, that the oil prices got weaker into that process.
That helped.
It may have been a different story. We may have had way more competition had prices stayed up through that process. And so I think we hit a stroke of luck there with the market kind of getting a bit soft. And I think it took some of the bidders out or knocked back their bid value.
And I think there might be a lot of short-termism with investors, and there might have been investors that have been disgruntled because they felt that now this acquisition pushes back.
Yeah.
Could you talk a little about how maybe the significance of this acquisition is so material to the future well-being of the company that it supersedes, that type of concern, which is having the return
Yeah.
pushed back. Yeah.
Well, first of all, like I explained to you earlier, so has to be accretive at your 5-year debt adjusted free cash flow per share at $55. So, and interestingly enough, this asset was more accretive at $55 than it was at $85. And the reason it is more accretive at 55 is the high quality of the inventory. It generates still a lot of cash flow at $55. And yeah, it brought very high quality inventory into the company. And so it was not, it's not a, so I think from the shareholders' point of view, pushing the enhanced dividend down the road, I realize that's a trade-off for a shorter term view on it. Now, I think with prices, we had hoped to be in that enhanced dividend by Q4 this year. That's going to get pushed off. I think we lost a couple of quarters because of pricing on that. But in terms of the asset performance, it's performing very well and meeting those expectations for sure.
And other companies were bidding for this asset,
Yeah.
and they may not have bid as high based on maybe an assessment that Tamarack's maybe limited ability to be able to execute on this winning bid. Why do you think maybe you guys might have been underestimated by some of the other guys that were bidding on this? I noticed that you also have a sustainable bond. Did that come into play and help you guys be able to outbid the others with that sustainable bond?
Yeah. So that sustainable bond helped a lot because the demand on that bond is really high. I mean, some lenders have to have a certain portion of their lending on sustainable, a certain percentage on sustainability. And so, yeah, this bond helped us in that transaction. We went for deferred acquisition payments, paying the shareholders, 50 million a quarter is what we're paying to. So we're still paying that now for the acquisition. And then the lending, we just, like I said, we had the lending base, so it increased our we had assets that we can lend against it. I would say of the competition for that asset, there was CEOs like myself that wanted to pay more, but just could not. It wasn't about the asset value. They saw the same thing that we did there, but just couldn't get you had to issue too much stock and there wasn't enough equity around, or you couldn't take that much debt. It became a financing exercise at that time. And so we just happened to have the magic sauce to be able to pull that off.
Yeah, and these are blind bids too, so it's just you have to put your best foot forward and then just pray for the best. So I did want to mention that to the viewer. The other thing is, what are some of the other advantages this sustainable bond provides? I noticed right off the bat lower interest rates compared to some of the other debt that other competitors have. Maybe any other things that you'd like to share about the advantages of this sustainable bond?
Yeah, so we have sustainable lending and a sustainable bond. First of all, it's interesting. We talked about different perspectives on the business, from retail to institutional, and then you have your bond guys, and the bond guys tend to align a little bit more with longer term. Actually, quite a bit more with longer term. Very good questions about. Show me where your 8-year inventory. Do your wells degrade over time? How does that work? How does water flood? Like really good questions on how to build a long-term business come from the bond side of this. And I think so. Hey, we talked earlier that a lot of ETFs and that were more longer term view and not the short term. I don't, I think what we've found in reality is institutional equity are 2 to 3 years tops. Their horizon. Retail might be shorter, is shorter for most. And the bond guys are 5 to 8. Like they're looking at your overall plan. So I really like going to them because you really get some good input and they really tear your plan apart. And in terms of you're right, we get a break on the interest rate, but the other thing, it just qualify. The demand is there, and for that bond. So where you might struggle if you don't have a bond, sustainable bond, it might be tough to get your lending. If you're sustainable credited, you can get your lending. You're gonna fill that all the time.
And I think, oh,
Three
sorry.
measures that we use. One is our ARO. We need to spend 150% of regulated amount on ARO. It's Indigenous employment. We're operating in a lot of Indigenous territories, so that not only helps us for the sustainable bond, helps us for our relationships with Indigenous people. And the third is the GHG reduction. And what I'm finding on the GHG reduction is we'll buy assets that actually have a poor GHG rating. They might be venting or flaring, and we're putting money in to collect gas and clean them up. And so you might see some like hiccups when we bring an asset in, where your GHG intensity goes up, but then in a year or two, then we'll bring it down after we get our capital investments in line.
And then I was going to say, any drawbacks in terms of now you've got limitations on flaring, which means that increases costs of trying to build those gas pipelines, rather than maybe some of the other competitors, which, potentially flare in lower zones. I'm talking about, not the higher zones where you're forced to be able to build a gas pipeline, but minutely. Any maybe drawbacks in that regards?
Well, we built in the gas gathering into the acquisition forecast, so it just becomes part of the valuation. You're going to burden these assets with cleaning up, running lines, compression, tying into somebody, and cleaning up that gas, getting your GHGs down.
And I did want to mention, Brian, like it's interesting because the interest rates that you got when I was looking at around 5-6%, and this is prior to interest rates really vamping up and taking off. So it seems like the bond was and the time which you got it and the interest rate that you got it was just super competitive, even relative to where the market has moved in regards to interest rate.
Yeah, interest rates have moved up a fair bit, as you know, and that bond timing was really good. Um, of course, now one of the reasons we want to pay down debt is just get your costs in line, because you're paying higher interest rate on the other pieces, right? And so that I think that changes our break even a couple of bucks if we get the debt down to our target. So it's pretty important to get debt down, and there's very little tolerance for debt. And the other thing is we want to get into a position where we're paying enhanced dividends or share buybacks, at least some kind of enhanced return. At this share price, it would definitely be share buybacks that we would deploy if we're down in this range.
And I had a friend of mine that walked me over the GeoScout. I was looking at, there's about 30 wells in Martin Hills that you guys have drilled, about average 133 barrels of oil per day. These are open hole multilaterals, so they're relatively cheaper. But would you say that these results have met, surpassed your expectations in terms of the production rates you've been able to get?
Yeah, and you got to be a bit careful of those IP rates, because they're actually higher when you look longer term. We just have a different way of putting these wells on. Some operators will, flow to clean up tanks and get all the water, because you lose quite a bit of water when you're drilling into the reservoir. So these wells come on with a lot of water when you start them, and you can either flow those to tanks and truck all that stuff, or you just go right down the pipeline and you put up with a higher water cut, and that's what you report when you see some of the tests that you got. So you'll see 133 barrel a day well, they're going up quite a bit over time as you clean up all the drilling fluids and things you got. So yeah, the asset has turned out really well. We hit an area where we hit another sand in the fall. I think we added about 40 locations that we did not have in the acquisition forecast. And then further, that West Martin Hills has turned out really well. And Headwater and ourselves have some really good exploration results in that. And so we've added more inventory with that. So yeah, it's doing better than what we had paid for, primarily through the exploration stuff that we've added.
Oh, that's good to hear. And the follow-up to that is in terms of when I was looking at the price, the PDP NAV per share is around about 88 cents.
Yeah.
And relative to some of the other competitors, relative to the price of the share, where it could be higher than or at, Tamarack seems to be a little bit on the lower end of things. So could you talk about why that's the case
Yeah.
and why that won't be the case moving forward?
Yeah. So there's a couple of things here to point out. When you do acquisitions, it's always a choppy year when you do your reserves after an acquisition. And one of the reasons that drives the numbers the way they are is that we paid for some of the inventory that they've got, but not booked. So you're issuing some equity in this case to pay for wells that aren't booked. So the cost goes in, but the barrels aren't counted yet. That's on the come. That's future to come. And because the reserve valuator won't let you book them. And booking unconventional and conventional is quite different. You don't get to book as much when you're conventional. They don't give you credit like, say, a Montney play or that sort of thing, where you put a large plant or facilities in and you got a whole bunch of wells, and they'll allow you, because it's a blanket sand, it's not too different, and those wells are there, and the reserve valuator will give you credit for it. Not so on a Clearwater. So there's a lot of inventory that we paid a small portion for, where the cost is there and the benefit will be realized over years, not when you first bring the asset in.
And the reason for that is because of its special characteristics.
Yeah, it's kind of like when you're conventional, you can book if you drill a well, you can book a well that next to it, you can call that a PUD, and 2 well spacing units over, you can call that a problem. And then that's it. That's all you get for credit for that. You don't get to book even the whole section. That's quite different than a Montney play. And also at the toe of the wells, there's no credit given for that. There's no booked well at the toe, even though you're clearly in reservoir. And then I would say that we're a little different than someone who's trying to prove up assets. So the right thing to do, maybe for your reserve, let's say I was drilling an asset just to sell it, and so I'm going to spread out my single wells across that asset so that I can book as much as I can. It's tremendously inefficient because you're having to build a lease for wells that are miles apart, and you're running around. And we just don't do it that way. We do it to drive costs down. So we'll drill wells right next to each other, even though the bookings won't be, you can't book as aggressively. What the shareholder needs to think about is that I'm driven by 5-year debt adjusted free cash flow per share. I'm driving to maximize our shareholders' profits. And the way to do that might not be to maximize the reserve bookings and as if I'm going to flip the property.
Got it. Yeah. Yeah. No, that was really good. And then the initial one was the initial question. I know it was I kind of presented a little bit confusing, but which is the proved, developed, producing. So it's already proved. It's already producing. So that one, I guess, when I asked you offline, you said is when you do a lot of acquisitions within a short period of time, that ends up lowering, and it will just take time for it to catch up to you, which is
Exactly. Yeah. Yeah.
for that question. But that the follow up to that is the answer you gave. And I think the other thing that you'd also mentioned to me offline, which is any reserves not used in 5 years is lost, and there's no credit for water flooding. is given by reserve evaluators. And then the other issue too that you'd mentioned to me was that they have to wait until it peaks and then
Yeah.
finds a plateau. And then at that point, and again, that's time duration. So just kind of helps to explain maybe some of the concerns people had with not seeing as much reserves that they'd hoped to see with the acquisition of after the
Yeah,
acquisition.
you're absolutely right. And I've talked to a few people about this because of 5 years and you lose it does nothing for someone who's got an 8-year plan. Like it means you're guaranteeing that 3 years of those wells are going to drop off and get taken off their books. So it's not, we have a tool that was used for a different time. It was used for a time when shareholders were looking at the next 2 to 3 years, not 8 years. And so, hey, but I do often wonder how much shareholders, appreciate that longevity of inventory that we have. We have over 1,200 Clearwater locations. Got a new area in Seal that's going to be a massive area to develop, and new areas in West Nipissing and West Martin Hills. And I don't know that a shareholder who's looking at a 2-3 year time horizon gives you credit for that. Something to really think about. But so far, that's the way we're measuring ourselves.
And then the follow-up to that is the year-end reserves have shown Tamarack's FD&A cost around $55 a barrel, recycle ratio of 85 cents. Could you maybe talk as to what led to those numbers and why we can be more optimistic moving forward?
Yeah, and you brought up the main example is that water flood. So Abe, is that reserve evaluators in areas where you have new water floods where it's unproven, they take a very cautious approach. I mean, you're calling this proved reserves, right? Very confident that you're going to get them, and you've just started water injection, and you might even have a little response. So you put in all that capital for water, water supply, distribution lines, drilling injectors, and you're only get a portion of the reserves booked back. So if you'd never do the project if you believe that booking was what you're going to get in the long term. But you can see, I could show you some curves where, where the reserve evaluator booked the water flood response and we're blowing out of the water. I still think we have one producer there that in Nipissing that's still 500 barrels a day. It's cumed like over 180,000 barrels. It's incredible. It's not that old a well. So, it next year there'll be some reserve bookings without capital because it's going to be they're going to give you credit for it. And you're absolutely right. You want to see something on decline so you can get appropriate water oil ratios and do some forecasting. While that thing's still inclining, they don't typically give you that much until it turns the corner.
And when you say you're blowing it out of the water, like what exactly are you blowing out of the water? Is it, the reserve revisions that you're going to get, or are you blowing the performance out of the water?
Yeah, they might take where the well's currently at. Like I can't remember that particular well what it is, but let's say the well went from a primary of 300 barrels a day to 350. They'll drop a decline off that and say, yeah, it's under water flood, but I don't have any proof it's going to perform, and we'll put a decline off that. In the meantime, the well has jumped to 500 barrels a day. Well, that's all gravy on a PDP from what you booked. So that's why I say it's significant or blown out of the water. Sorry about the
Wow.
pun. But it's performance that they would have never drawn in and never given you credit for. And if you take that to them now, they'll say, "Great, I'll give you credit next year for that."
So you can have the expectation that there's going to be a material upward revision as more of this
As more of
EOR.
this comes, yeah. And keep in mind, so Abe, there'll be other areas where you haven't where you're adding on and you haven't demonstrated the uplift yet. So they're still going to peel those back. So it's not going to be, it'll pop way up in the area where you've got the great performance, but there's other investments you're going to be putting in on water flood to expand it, and they're probably going to take a cautious approach there too.
That makes
So
sense. More of a duration game, but for people that are in it based
absolutely.
on the 8-year plan you've highlighted, then it, probably won't matter as much unless you're on the short end of things, which
Exactly. Yeah.
okay. You know, Brian, they say if through the passage of time, if you're still as happy as the first day you bought it, then it's probably true satisfaction. So 9 months later, about 8, 9 months later, how happy are you still with this DeltaStream purchase?
Oh, it's a phenomenal purchase. It's just going to give us when you buy, like, I think if you actually looked at the bookings and everything we're at, I think there's a chart in my presentation. We're only like 1% of oil in place or something like that,
Wow,
produced and booked to
wow,
date. So it's just there's
that's
gonna be like, when you guys find different ways to get it out, you find different layers, there's just so much that is going to be happening here because you have the volume in place. You have something to work with. And DeltaStream it was the creme de la creme. It's 3 times thicker than Nipisi. And so, it's going to be it's we're really excited about it.
Brian, this asset may potentially be what makes you tap dance to work every day. This is
Yeah.
makes
No,
you
it's
adds the extra pep in your step when people see you walk in the plus 15s.
yeah, well, you go from yeah, I mean, think about it. We built a company based on something like 4 million barrels a section. And we did pretty good with that, with the Viking Cardium, even water flooded some of that. Now you're working with 60. Incredible. It's just a game changer. And so what I'm really proud of, so Abe, is we decided to make a strategic change at the right time, and we made it. And we'll probably move out of some non-core assets, core up. I think for the shareholder, they should look at others that are trading that are pure Clearwater players. And the market will have to move us, our multiples, toward that, because that's what we'll be. We'll core up in the Charlie Lake and Clearwater, and it'll look really good.
So, Brian, now you've gotten a chance to develop your core assets, high grade your assets. You've got a great path set forward. Speaking of divestitures, now, is there anything you wanted to speak about? Now you may feel like you're in a position where you can start divesting assets. How is that looking, or is there anything new that you can add in regards
Yeah.
to?
So we've divested some minor assets last year. We sold our Saskatchewan Viking. We sold Quaich, Southern Alberta. We've got a process in Redwater for sale, and we've got our Cardium assets now up for sale. And if you don't put capital in, you better sell them. And I actually like the quality of some of those assets, but it'll never compete for capital with what we've got and the massive amount of inventory we've got in the Clearwater and Charlie Lake. So I think it's some time for someone else to take those assets. If we move those assets, then we're moving faster toward our enhanced return structure, either dividends or share buybacks. And we're, putting the company in a position of strength. If something did come along, then we could buy it, where I don't feel we can do that now. We can't. We've signaled to the market we're going to pay down debt and get ourselves in that position before we do anything like that. So we're going to be fairly disciplined about that. So we'll see how the bids come in. You never know. Maybe they're too low and we end up keeping it, but maybe we move it on. We'll see. And then I think the other thing, Sohaib, is there'll probably be some facilities there that we'll consider moving and paying back fees on those.
And that Cardium asset is an 8,000 barrel a day asset. So that's
Yeah, I think it might be a little less now, around 70. But yeah, it's a nice asset. There's a lot of different zones in there to go after, and good facilities controlled. So I think it's a good quality asset.
And once these assets start getting sold off, and do you see this as in terms of shareholder returns, is it going to accelerate shareholder returns,
Yeah.
or is this going to be more of going to go into capital spending?
No, it basically, I think we'll probably take, depending on how much we get in, um, we may, because remember, anything I got to do has to be accretive. So, so,
Yeah.
so how do you sell something at less? You're probably going to have to sell at less cash flow than you're trading, slightly less or whatever. So you got to make that accretive. So I need to take some of that money and probably put it in drilling some clear waters wells to make it accretive. But the bulk of it goes down to pay down debt, and that will accelerate our debt ceiling where we start paying um, enhanced dividend or buyback shares, and that's when our debt gets to 1.1 billion.
That's that's good to hear because for some investors that are concerned that there may be more acquisitions along the way, they can be rest assured knowing that they'll probably see more divestitures than they see acquisitions moving forward.
Absolutely, yeah, absolutely. We're not in a buy mode right now. We passed on. Obviously the market knows there's other Clearwater stuff came up. Um, we've been disciplined and haven't not biting on it.
Now,
So
oh, sorry, go ahead.
so yeah, I think shareholders can rest assured that
Yeah.
our focus right now is to divest of some non-core and get that payment accelerated.
So now we're starting to wrap up here. Just a couple more questions. One of the last segments we have is just call to action. Why Tamarack now? And I want to start off with the question, which is why do you think the share performance has struggled thus far? And then we're going to touch point on some of the catalysts that you see on the horizon
Mhm.
for Tamarack.
Yeah. Well, I think the share price has suffered a bit because of a few things. One is, um, there was a block trade came earlier. There's a little bit of stock left to come out, and people are worried about when that comes out, what happens. So that's stopping people from stepping in. I mean, oil price, the differentials kind of got pretty wide there just after the acquisition. I think we were up $22, and despite us putting that in the plan, it makes people nervous where it's at now. That's collapsed and come in quite a bit, and it should continue to come in as Trans Mountain gets in place. So I'm not too worried about differentials, but I know shareholders were worried about that. um and I think people just want to see how you digested a big one. How's that going? And the risk of, you don't have to step in. You can see how the quarters go and make sure there's no missteps on the acquisition. And I know we're going to prove that one okay. So I think you'll see folks step in once we clear that block. And I think once especially if we divest and core up, I think you'll see shareholders appeal go up quite a bit.
Yeah, and I think that what misunderstanding, if any, would you say that shareholders currently have about your company?
I don't think they appreciate how good these Clearwater wells are and what that can do to your business plan, number one. Number two, I don't think there's an appreciation for 8 years of inventory, that we've got good quality inventory at 8 years. And number three, the pressure maintenance programs that we want to put in place in the Clearwater, they're not built in yet. So I think those are probably the three misunderstood pieces that the market may have on the story.
And then in terms of I remember one individual was highlighting the fact that the reason ARC is selling is because they have no faith in the asset. But their private equity team, they bought into it just to help facilitate the transaction. Could you maybe address that
Yeah.
as well?
So I mean, their belief, first of all, they believe in the asset and they believe in the team. So this is not the first time that we've done deals with ARC. They know us very well. There's a lot of my peers that I used to work with at Shell over there that are in those kinds of making those kinds of decisions. And we've done very well for them in the past. So we had good credibility with the ARC investor going into this process. They had alternatives that were more cash related, but they chose to ride this story out because they had confidence in the assets and the team. So I take that as a pretty good vote of confidence. The fact that they're getting out, and you know, they're private equity. They are going to get out over time. It's just a question of how long they'll ride in, because their investors have a time horizon that they're going to. So they will move out over time.
Yeah, and that's the feedback I've gotten. They have to realize those gains to their unit holders, which is,
Exactly.
immediately. So the lockup is just as soon as the lockup's over. And sometimes it's you guys give them the, if you feel that there's strong enough liquidity, you lift it and you say, all right, you can sell it sooner, which is what took place when they sold
Exactly.
the
And you
last
know,
block.
they come to us for approval on that block, that they wanna move it. And you know, we'll assess it at the situation at the time and see if that's in our shareholders' best interest to allow that to happen or not. And in this case, it was. Let's move some of this through, so that there's not a big, huge, there's not so much at the end. And we have approval, I think, till October, I think is the time frame there.
So, Brian, for what do you think are some of the catalysts that should incentivize shareholders to own Tamarack now? Do you see any, short-term Tamarack, catalyst on the horizon? I see your divestitures, depending on when they go down, as a major potential catalyst, if that could be materialized. But is there any other catalysts that you can share?
Yeah, I think the divestiture of both assets, and if we move some of the infrastructure, I think is going to be key to moving it forward. Otherwise, it's still not a bad plan. You basically, we only push the enhanced dividend out a couple of quarters, and or share buyback a couple of quarters. So you're going to see that happen relatively soon anyway. It's just going to be an upper if you move the assets. The seal area it's a great area. I think I said it's somewhere around 50 to 60 million barrels a section. We had great exploration results in West Nipissing, West Martin Hills, and Seal. And goes through and further demonstrates that play is not a mature play, that there's lots of running room. And we're not the only company that had exploration success. Spur and Headwater had a really good drilling campaign as well. So there's lots to do yet in this zone and other zones here going forward. It's pretty exciting.
And I guess the last question before we wrap up here is, in terms of the shareholder return plan, noticing, where prices have come, where the share price, not only just Tamarack, but the entire sector, based on the drop in oil prices and maybe the waning sentiment. Do you see that as an opportunity for any significant buybacks? You do have about, what, 38% debt to total capital, so there could be an opportunity to maybe even lever up for some more buybacks. But again, you've shown yourself to be prudent operators. So I just wanted to maybe get your thoughts on something like that before we wrap up here.
Yeah, I think we are focused on getting that debt down to the 1.1 billion and start the enhanced program of that, and then start buying back some stock with the enhancement. That's where we're sitting there. You wouldn't see us buying back shares before we get to the 1.1.
Awesome. So at this point, I wanted to just do a quick shout out to all the individuals that have helped me with this segment. This segment has been maybe one of the more comprehensive ones relative to the ones that we've done in the past, considering that I just felt that with this one, there's a lot of misconceptions that needed to be addressed. A lot of acquisitions have taken place as well, so required a little more maybe a more intensive approach. So a special thanks to that one individual that helped me with the Geoscout material, and along with Tom McInnes and many others that have used as sounding boards. And also at this point, I really wanted to share my appreciation for you, Brian. We spent some considerable time on this. We have a part and a B part that we shot on separate separate days, where the first one focused a little more about you and now a little more about the company. So I did want to share my appreciation for you, and also sometimes there's some type of risk for management to embrace maybe new unconventional ways of reaching out to shareholders maybe than years prior. Last year, you embraced the new technology of Twitter Spaces, and that was lovely. More than 5,000 listeners. It really demonstrated an appetite that there was just a market for something like this. And I did want to share my appreciation for really stepping up the efforts in shareholder communication. And I think this went pretty lovely.
Yeah, I think I was very impressed the first time we had on Twitter and the following we had. I'm on Twitter watching what all you guys say, so it's kind of I get a kick out of it.
So you might have seen the poll then,
But
Bergen's poll, the Baytex Tamarack poll. That was
yeah,
right at the hair there. We're gonna see.
yeah. So I this is a good way to connect, and good on everybody for pulling this together. And discussion leads to good solutions and good answers, and I think you have something really special here. So thanks to everybody for pulling this together.
Absolutely. Thanks everybody for listening, and we'll see you guys at a future session. Don't feel to like and subscribe in the video, and I've also in the bio would include the segment that Tamarack did with CTV, where they highlighted them as part of the entrepreneurship segment. Until next time, all the best, and take care.